And good afternoon. Welcome into Market Talk for this Wednesday, January 26th. Great to have you with us, and thank you for making us part of your day once again. I'm your host, Jesse Allen. Again, thank you for joining us. Find us online, markettalkag.com. That is our home on the web, markettalkag.com. You can find all of our social media links there, the latest news of agriculture, all of our streaming sources, and much more. It's online, markettalkag.com. Well, as we take a look at Wednesday's trade, we got a lot of the same fundamentals going on as we've had here all week long and since last week. But soybeans led us sharply higher today with corn up moderately. Wheat, though, was under a lot of pressure today. So plenty to discuss. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here on this Wednesday afternoon. Mike, good afternoon to you, sir. And, what an interesting week it's been since we last talked. There's a lot of items out there in the news that are kind of helping drive these markets right now.
Yeah, Jesse, behind me, I've got some key maps that I use quite a bit. China, Brazil, I think where that clock is, I'm going to have to put one up of the Baltic and Russia and Ukraine here if things keep going the way they look like they're going to go. And what I mean by that is I think that just eyeballing it and just looking at it with a political science degree from 30 some years ago, it sure seems to me maybe that Vladimir Putin, who's 69 years old, is wanting to get put in the history books once and for all. And he has an empire that he wants to finish off. And I think we need to plan for this market or for this invasion. And I think the market's certainly doing that. And it makes me wonder whether, along with the weather shifting in the plain states, whether the profit taking in the wheat maybe had something to do with the fact that they've ridden that wheat high enough on some of the geopolitical fears. And I wonder if some of the end users in the Middle East didn't buy a little extra last month and earlier this month ahead of what's happening right now. So wheat remains my leader as I conclude this start of our show. And by the way, thanks for having me back.
Well, I appreciate you being back, and I'm glad we dove into wheat there a little bit. We can stay on that before we go to soybeans, which I think were the big winner today, probably by a country mile. But on this wheat market, the geopolitical issues, it felt to me like this was just some profit taking today in these wheat markets. You mentioned it, that we've run up to a certain level, and maybe some traders are just they're putting this Russia-Ukraine news to the side because nothing has really happened yet. We've been talking about this for over a week, Mike.
Yeah, to kind of bring together the beans and the wheat and the corn, I think we've hit price levels in all three where we need to feed the bull. And I think you're right on the money there. We've run the bull hard when it comes to the Russia-Ukraine issue. It doesn't mean we can't run it harder, but now we have something that's not feeding the bull, and that is a lot of snow in western Kansas in feedlot country. I think that woke the weather bears up a little bit. And the weather models now are starting to suggest for the wheat belt, the plains wheat belt specifically, that we could see a lot of Gulf moisture kind of come in and get trapped in the center part of the country. Will it get west enough and north enough to help the winter wheat and the hard red wheat belt? That's the big question mark. But to see warm Gulf air and a lot of moisture coming in this time of year is an odd situation to see in the middle of winter, given where the jet stream usually acts. So what I mean by that, Jesse, is I'm dubious about this forecast, but I think the market's taking note at a time when we needed to feed the bull. Beans got the bull fed, wheat did not, and I think that's kind of what this market looks like after Wednesday's close.
And I think helping out that winter wheat crop, I talked to Eric Snodgrass here, and he mentioned how his backyard of Champaign, Illinois, they've barely seen any snow. So some of that winter wheat area there in Illinois and some of those regions, they're not seeing that moisture that they normally would see this time of year. So I think that's an interesting point you make there, maybe helping out some of these winter wheats. And on also, the snow that was seen in western Kansas and the plains, still not enough to help the drought there, Mike.
No, and I talked to a cash client today that I work with on a per bushel basis or per acre basis, however they want to do it, mainly per bushel basis. And he said, well, how could wheat go higher? And I said, well, if you look at the drought monitor and you look at the supplies around the world and you incorporate an embargo or a type of Black Sea moratorium by the Western nations, or Russia doesn't want any Ukrainian wheat to go out for some period of time, you can make the case. But I think the key point is This market continues to be weather and supply driven, not demand driven. And so that's where I could see a sharply higher wheat market, Jesse, in 30 days if we don't have the rains and the moisture that we need in the hard red wheat belt all the way up to Montana, because the drought monitor, as I referenced, in some of these states like Oklahoma and Texas, they are much worse than they were a year ago levels. And I think the trade will start to realize that after the month of February, because after February, it's pretty much too late to help the wheat that hasn't been able to recoup and germinate. At that point, it dies. And so that's what a lot of the farmers are telling me. The wheat growers are telling me in Kansas and Oklahoma right now. It could go either way. It could be a decent crop, or I could lose a lot of wheat in harvested acres or national yield. One or both go down.
Well, let's segue into soybeans. On the flip side, big winner today. I think a lot of that maybe was tied into a few factors, crude oil being higher, helping out bean oil, palm oil, but also South America. And, we're starting to get some production estimates that are, I saw some sub 130 today. So, I mean, walk us through what you saw with soybeans and what you're seeing maybe with the South American front of this and how this is all playing into the soy market.
Yeah, you nailed it with the sub 130 talk, and Saffras Mercado kind of put the icing on the cake today with coming in on an export front of only 85.5 million metric tons being shipped out of Brazil in their most recent estimate. And that takes you down 8.5 million tons from USDA's official number, takes you down about 2.5 million tons from last week's attaché at the USDA in Brazil's number. And so this is where the bull got fed in the soybeans. And as you say, we've got that linkage still pretty clearly defined between soybean oil and crude oil. We also had, unlike we've had the last week or two, instead of buying bean oil and selling meal, it looked like the short cover mindset came in on the meal market, and March meal was really close to getting back up to $400 a ton on a close. And we'll talk about that in a minute. But the key here now is the crop is getting smaller again in the trade's mind. And we once again are moving ahead the February WASDE report like we did last week with attaché report coming in as well. And so what this chart shows you, and the numbers are hard to read, but just take a look at the end of the chart where the blue and the red come together and end up being the total. This is the Brazil, Argentina soybean production number. And what it's telling me is our production number is getting closer and closer to 2019, 2020 levels, if not going below it. Because if we have another 5% cut in Brazilian soybean stocks, or excuse me, in world stocks, that will mainly be on Brazil and a little bit on Argentina, I suspect. But Jesse, that'd take us down to around 90 million metric tons. That puts you right around that 2019, 2020 level for production. Now, as far as ending stocks, you go down that low, all of a sudden you're getting low enough that you're close to 2014, 2015 ending stocks levels, and 2017, 2018 ending stocks levels. So all of a sudden, that number of 160, when you follow those bars all the way out, that when you go down below 160, you start to get a really serious issue build up with needing to ration demand relatively quickly. And that's what we're really looking forward to as we go into the February WASDE report. One last thing is what I'll do with this chart for my clients and subscribers is I will start to figure out as best I can using some proprietary information that I've built up over the years of what I think the trade is factoring in. Are we at a 160 carryover globally, or production level globally when it comes to Brazil and Argentina at this point? Have we gone below 160? What is the trade pricing in as we get closer to that February WASDE report? That then will trigger my recommendation to move more 22 beans or not before the report. I just finished up with 21 beans this week.
Let's talk about this the continuation chart here as well, and you can walk us through this. And I look at beans on the board here. Just one comment. 1450 July beans, 1440 front month March. I mean, we're pushing up there towards some of those levels that I think a lot of folks thought would be maybe that resistance overhead, that 1450 1460 area. So maybe you can comment on that, and then talk about this soybean continuation chart as well.
Yeah, that long-term trend line that you have in the green, which made, and in the resistance line, which made a wedge, that was a really key point. You and I talked about this, and we talked about the gap above the market at around 1420 area. And so what the market was looking at today was being able to get above last week's high of 1429.5. When we took that out, there really was very little resistance until you get to this channel band, the purple top of that purple band of trading channel of around 1450. And that's ultimately, I think, where the soybeans will probably want to find a little pushback by the shorts and probably grind a little bit more unless the wheat and the corn come on board with it. And that's a real key point. Wheat, corn, meal need to come on board here if we want to go back to those April, May, June highs of last year. And this is where that previous slide comes into play with that production number going below 160 million metric tons, taking world ending stocks down well below 90, maybe even closer to 80 million metric tons, where we were around 2014, 2015. So what I'm getting at is with new supplies, even though they're going to be shorter supplies, and with prices elevated for an extended period of time, if we want to take out those April, May, June highs, I really think we got to have the numbers underneath us, and we've got to have meal, wheat, and corn underneath us as well. Beans, I don't believe, can do it alone at this stage.
Well, as well, we talk about meal, and you touched on that a couple of times. Let's dive into the meal chart a little bit more. And you mentioned earlier how it seemed that meal and oil stuck together with soybeans today and traded their way higher. So, talk about what you're seeing a little bit deeper into this soy meal market.
Yeah, this is a really neat chart because it's got a couple interesting dynamics to it. We went down to the blue trend line and pretty much tested that, came real close to testing it. And that happened after the January meal went off the board at a steep premium to the now lead month March meal. And so we've got a gap well above 420 at this time because of where the Jan went off and the March came on. So March goes down, and now this second week since the January went off the board, the March is trying to climb back, as I said, above that $400 a ton level. What we really want to see is the March meal now go above last week's high, which is right around 405, 407 area. If we can close above that on Friday, that negates the sell signal that oscillator is showing you in the bottom third of the chart, where the green line is crossing through and going below the purple line. That's a sell signal. That says momentum's weakening, in my opinion, in terms of new buyers wanting to come in. So we need higher highs on a weekly basis. That gets us into the gap. And then the momentum traders will likely step back and say, I'm leaving this alone until that gap is filled. This is one of the key points I think I'm trying to make with clients, that if we want beans to go up to those old highs, I would think that soy meal gap above the market would be a major reason why a lot of maybe technicians and people that don't really care about fundamentals would jump into this market.
Well, on the other side of this equation, we have corn as well. And corn, I feel like, it's kind of caught between the two still, between wheat and soybeans. Soybeans maybe won out a little bit more today, helping pull that corn market up slightly, but wheat also kind of kept a lid on it. Talk about this corn market and your thoughts with where we're sitting after Wednesday's close, Mike.
Yeah, I mean, I think one thing that you didn't add, you had a lot of good things there. One thing you didn't add was, I think the ADM management coming out during their earnings call talking about 93 million corn acres probably put the lid on this market for a while, and I'm dubious of that number. Of that number, I mean, I think that it's going to be closer to farm futures number at this point. So I'm real dubious of that big of a corn acreage base, but I think the trade got a little bit nervous about that. And I think, to the point of what we've been talking about in rationing demand, we don't have the bull being fed when ethanol numbers go up again on a production number that is declining. And this really shows you the power of unleaded gas prices and Omicron variant driving down demand. Both of those two things, I think, are hitting the demand. This is the second or third week in a row we've had some increased ethanol stocks. And now the unleaded stockpiles are the highest since February of last year. And I think this really starts to grind against the idea that the corn is going to see increased demand. First of the week, we had the cattle on feed report that really helped us because those placements and on feed numbers were above the trade guesses. And that said corn demand, domestic corn demand. Now we've traded that and priced that in. Lastly, Jesse, I think, and this is a key point that I think maybe is more short term, I think we just flat out had some farmers selling. We hit 6.25 front end corn. I sold some old crop corn, and I got up to about 50% sold on old crop corn, doing another 10 to 15% increment this week. So at these kind of price levels, 7-month highs, wheat breaking up to its old resistance levels, beans breaking out. These are the kind of things that I think really are great ways to sell into a market.
Well, on top of all that, we have the Fed, and I know Fed meeting wrapping up today. Anything you've seen from the Fed comments that stood out to you, or was it as expected, Mike?
Yeah, I don't know if he's going to do a Chairman Powell, the what I call who I call the fat lady because he's sung now. I don't know if he's going to be doing a press conference or not, Jesse. But if he doesn't, I don't see anything that would suggest that we need to take the bonds any lower and the bond yields any higher. That they've priced in 3, if not 4, rate hikes this year. They've already priced in quite a bit of balance sheet erasing. And the Fed came out today and said we're going to start in March. Well, that was not news, in my opinion, especially given what the prices have done. So this takes us back to this incredible volatility that you and I have been talking about for probably 6 months. That is not going to stop because the crude oil making new highs is going to keep the commodity index funds generating new longs in all the commodities that are in the basket. And at the same point, in the same time, while the crude oil goes higher, is that going to push the stock market lower because we're getting more negative economic data and we're getting more tensions build up? And the higher the crude oil goes, the more the trade starts to talk about, excuse me, starts to talk about recession. So this is going to be really tough to hedge in. It's going to be really tough to market in. Don't think it's going to get easier. It's going to get harder.
How about livestock? We better touch on cattle and hogs here today. I'd say the hog market, if anything, there just kind of chopping sideways today after some impressive runs higher, Mike.
Yeah, I think we've hit a limit. We need to feed the bull, kind of like the other markets. We've got the futures in February now, $9 premium to the CME index. That Fed futures goes off here and hits its expiration month in less than a week. So I think you got to balance those two things out. Either we need some strong export demand to bring the cash index up at the Merc, or I think the February hogs either go sideways or go sideways to lower to kind of balance up as it gets ready to go off the board mid-month.
On the cattle side, it's a little bit of a different story. We did find some support today on the futures trade. We look at cash country between yesterday and today, steady to $1 lower in the plain states. What are you seeing with cattle futures right now? What's the direction you're leaning as we work through this week?
Well, the on-feed report and the placements report, especially on cattle on feed last Friday, was what we had been fearing, what you and I talked about. Big placements, really big placements, largest displacements ever since the report started back in 1996. We had to price that in, if you ask me, Jesse, especially given moderate marketings on that report. And also with this slippage of 10+% in the stock market at times, 10% in one day at times, I think the cattle just had to feel that because that cattle S&P 500 correlation positive relationship is still almost 70% on an 18-week basis. So feeders, Wall Street were what was, I think, going to have to push the cattle down. Fortunately, we gapped lower, and now we've got a gap in the April up around 142 to fill. I think if the stock market and feeders can balance themselves out as we go into Friday, I'd be looking for those fats in the April contract to get back up into that gap and fill it. Why? In part because I think the Packers have a hole right now from not just the Omicron variant, but also this winter storm that hit Garden City, hit Dodge City, hit the main part of the Kansas cattle country. And I think they are probably short bought at this point because of Mother Nature and Old Man Winter coming in. So I am very strongly urging ranchers to be very patient on marketing market-ready cattle right now.
Well, Mike, a lot of great insight as always. Any final thoughts you have for us on this Wednesday?
I think you tapped me out today, Jesse. You have a great week, sir.
I will. And I know folks can find your great research and more globalcomresearch.com. That's globalcom with 2 M's, globalcomresearch.com. You can sign up there for a free trial as well. That is where you can find Mike Zuzolo's information. With that, we will wrap it up for this Wednesday, January 26th. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.